Welcome to The Explainer. You ever wonder how professional investors look at the absolute chaos of the market and actually manage to put a number on risk? Well, today, we're prying open that toolkit and pulling out two of their most powerful instruments, correlation and value at risk.
So let's kick things off with something you've probably noticed yourself. Some assets, some stocks, they just seem to move together, right? It's like they're dancing to the exact same song. When the market goes up, they go up. When it goes down, they tag right along.
Right, so that's the big question for any investor, isn't it? How do you actually measure that dance? How can you put a real solid number on the relationship between two different investments?
And the answer. It's a metric called correlation. It's actually a pretty simple scale. It just goes from -1 to +1. If you get a +1, it means two things are moving in perfect lockstep. A -1, they're moving in a perfect mirror image of each other. And 0 means, well, there's no real connection at all.
Okay, so we need to pause here for a second because correlation is an incredibly useful tool. But, and this is a big but, if you use it the wrong way, it can be so misleading. There's a classic trap that a lot of people fall right into.
Okay, check this out because this is wild. If you just take the price level of two things that are generally trending up over time, like say the stock market and, I kid you not, reported UFO sightings, you get this massive 94% correlation. But it's meaningless. It's a statistical illusion. The real key, the thing you have to do, is compare the returns, the day-to-day changes, and when you do that, the so-called relationship between stocks and UFOs completely vanishes. It drops to basically 0.
So, measuring these relationships is a great first step. It's super useful, but it doesn't answer that one huge question, the one that really keeps every risk manager and every serious investor awake at night.
And that's the billion-dollar question right there. It's not just about how things move together anymore. It's about how much you can actually lose in cold, hard numbers when things really go south. The tool the pros use to answer this is called value at risk, or VAR for short. Its whole job is to do one thing: put a dollar amount on your downside. It basically says, okay, with a certain level of confidence, say 95%, over a specific time, this is the most you should expect to lose. So how on earth do you calculate something like that? Well, the most intuitive way, the place we should start, is to just look at the past. Let's see what's already happened. This is called the historical method. And honestly, the historical method is a beautifully simple three-step process. First, you grab all the historical daily returns for your asset. Step 2, you sort them all from the biggest loss all the way up to the biggest gain. And finally, you just find your cutoff point. So if you want a 95% confidence VAR, you just look for the 5th percentile. You're basically saying, out of the last 100 days, what was my 5th worst day? That's your number.
And this chart here, it shows you exactly what we're talking about. This is a picture of Bitcoin's daily returns. Now, for VAR, we're not really interested in that big lump in the middle. We are laser focused on that long tail stretching out to the left. That's where the history of really bad days lives.
So when we apply that historical method to all of Bitcoin's data, we get a very specific number, -6.02%. What this is telling us is that based on its entire history, on any given day, we can be 95% sure that Bitcoin will not lose more than 6.02%. Now, to really get a feel for what that number means, let's run the same calculation for something way more stable, like a bond index. Its 95% daily VAR is less than 1%. And just like that, you can see the enormous difference in risk. Bitcoin's potential bad day is more than 6 times worse than a bond index's. But here's the catch with looking at the past. What if the past isn't a perfect guide? What if something happens that's never happened before? That's a pretty major limitation. So, there's another method that tries to forecast risk using statistical models instead of just replaying history. This is called the parametric method. And instead of just looking backward, it makes a pretty big assumption. It assumes future returns are going to follow a predictable pattern. You know, that famous bell curve from statistics class. The cool thing here is you're not just limited by what's happened before. You can use the math of that curve to calculate the odds of future extreme events.
So you see, there's a really crucial trade-off here. On one hand, the historical method is simple, it's grounded in real events, but it's totally blind to something that's never happened before. On the other hand, the parametric method is more flexible and forward-looking, but it's only as good as its model. If you get the model wrong, your VAR is going to be wrong. Simple as that.
Now, VAR is great. It's a fantastic tool, but it's got one really big limitation.
It tells us the line in the sand we probably won't cross, but it tells us absolutely nothing about what happens if we do cross it. What happens inside that worst 5% of days?
And for that, we need to pull out one more tool, conditional value at risk, or CVAR. This one answers that terrifying follow-up question. Okay, I know the line I shouldn't cross, but if I do, what's the average damage going to look like on the other side?
Let's just go right back to Bitcoin. We know its VAR is that 6% loss. That's the wall. But the CVAR, whoa. The CVAR tells us what happens when the floodwaters come over that wall. On those worst 5% of days, the average loss isn't just a little bit worse, it's a massive 9.08%. That's the difference between a really bad day and a potentially catastrophic one.
And there you have it, 3 core tools straight from the Professional Investor's Toolkit. You've got correlation to see how your investment stands together, you've got value at risk to draw that critical line in the sand for your losses, and you've got conditional VAR to understand just how bad things can get when you're forced to cross it.
Which really just leaves us with one final thought to chew on. Having these incredibly precise tools to measure risk is, well, it's powerful. But does being able to measure risk mean you can actually control it? Or does it just give you a much clearer picture of the chaos you're trying to navigate?